Good morning. Today I'm coming to you on a new video setup with much improved audio and a brand new backdrop of my new office right behind me. Today's video is a result of all the comments and feedback that I have received from many of you, and I really appreciate it, and you know who you are, so thank you again for watching and thank you for your feedback, and I hope you enjoyed this new video with much improved production value and production quality. Today I want to talk to you about our investment process, because I believe in an investment process and refining one's investment process is the most important thing any investment manager can do. We cannot control returns in any meaningful way in the short term, but the only thing we can do is maintain discipline and refine our investment process. Performance at the end of the day is an outcome of a good investment process. I believe a good investment process has to be consistent, predictable, and repeatable. So it has to be consistently executed and consistent in identifying what kind of investment opportunities you're looking for. It has to be predictable over some meaningful period of time. It has to generate some returns that you can model and that your clients can model and understand how they fit in their greater portfolio. And it has to be repeatable over time, because one-off kind of big predictions, if you will, one-off big shorts about the economy or one stock idea type investments are really not what clients sign up for when they choose an investment manager for the long term. So with that, I want to give you some more insight into our investment process at LRT. We're global equity managers, active equity managers, and we're looking for companies that have three characteristics to invest in for our portfolio. We're looking for a company that has a strong and durable competitive advantage, some kind of moat. We're looking for a company that can grow and reinvest capital within that moat at high incremental rates of return. And we're looking for a company that has a management team that is excellent at capital allocation and understands how to use capital allocation in a way that maximizes and amplifies the value of a good business. So those three criteria, a moat, growth, and good management, is what we are looking for when we want to make an investment. And today, I want to illustrate our investment process with an example of a company that all of you probably know and use their products many times a day. In fact, it's a company that has been very successful for investors and has returned over 23% per year since it IPO'd about 15 years ago. The company I want to talk to you about today is Google, and how I evaluate Google on all the areas that matter in our investment process, and why ultimately we chose not to own Google, and why I think this is a good example that illustrates the consistency and the rigorous execution of our investment process, even though it's a controversial idea not to own because it has been so good for many investors. So when we think about Google, we start always the analysis with the moat, the competitive advantage that the company holds. And in Google's case, it is effectively a dominant monopoly in the global search engine market. It holds over 85% market share globally and over 90% in some European countries. For the last decade or so, there has been really no competitor in Google for the core search engine business. But Google is more than just a search engine. It's also the dominant email and video platform with Gmail and YouTube respectively. And Google has made a number of investments in other areas, including their very fast growing cloud initiative, where they compete against Amazon and Microsoft. But if you just take Google and its search engine, we believe Google's search engine is likely to remain the dominant search engine for at least another decade, if not longer, supported by the massive scale and massive R&D that has gone into developing its algorithms. The proprietary nature of its algorithms and the scale required to store, search, and process all the information almost guarantees that Google will be the dominant search engine 10 years from now. Secondly, Google can still grow much faster than global GDP for many years to come, because Google at its heart is an advertising company supported by advertising dollars moving online. And as more and more of our time globally is spent on the internet, on global internet properties, on watching video, those dollars, those eyeballs, if you will, that time will turn into dollars and be monetized. And a lot of it will be done on Google. They have an incredibly effective advertising platform that allows for very good measurement and very good targeting of advertisement for media dollars. And last year, advertising online has finally surpassed the 50% mark of all ad dollars spent in the United States. And I believe that number will continue to grow. So Google will continue to grow its share of advertising dollars in the advertising market, which is continuing to shift online. So it's likely that they will grow much faster than global GDP for at least another decade. So why don't we own Google? It has such a great moat and such great growth opportunities. The reason we don't own Google is the third criteria that we look for: capital allocation. So let's talk about the capital allocation and the corporate governance at Google first. Corporate governance at Google is pretty poor. Most of you may not know this, but if you own Google stock, you own non-voting shares. In other words, your ownership in the company has no impact in your ability to influence management or the board. So Google can do whatever it wants with no fear of having to answer to public shareholders. And the company has said they do this because otherwise if they had to answer to public shareholders, they would be forced into short-term thinking or quarterly decision making. And I think that's a very bad, it's a cop-out answer, if you will. I think it's not genuine, and I think it just shows that the founders want to maintain control rather than have to have their decisions questioned by Wall Street. And let's face it, Google's management team has made some crummy decisions over the years, specifically when it comes to capital allocation. There is no clear capital allocation strategy at Google. Today, it is a global near monopolist in the global search engine business, and yet there's no way for it to reinvest all the capital internally. It reinvests some internally in growing its search engine, but what does it do with all the excess capital? There's no clear strategy that management has followed. They have done several things with it. They've done acquisitions, some of which have turned out really well, like YouTube, for example, and some others perhaps that you can name, like Android. But others, like Nest, have turned out really poorly. Other ideas for redeploying capital, like Google Fiber, have also been disastrous, where they've tried to basically dig ditches throughout residential America and lost so far several $100 million doing this. And so there's no clear path for internal reinvestment and no clear strategy for capital redeployment. The company also likes to moonlight as a venture capitalist. It has several venture capital arms. And again, I want to be invested in a fantastic company that's trying to maximize the value of its moat, not operating or moonlighting as a venture capitalist on a side. So when you look at it, there's been no clear strategy for Google to manage its cash hoard, and this has resulted in a growing cash pile at the company, which is really the final nail in the coffin that's really unforgivable. Google has refused to repurchase shares in excess of stock-based compensation issuance and has refused any kind of capital returns in the form of dividends to shareholders. And given its position and limited reinvestment opportunities, it should be doing that to maximize the value for shareholders. So that's ultimately why we choose not to own Google. Their capital allocation strategy is all over the place, and we have no space in our very limited concentrated portfolio for companies that are compromised in one of the three areas that we're looking for. And I hope this gives you some insight into our investment process at LRT and how disciplined we are in sticking to our process. We believe there's over 50,000 companies we could invest in globally. And so we have no space in our portfolio for companies that are compromised in some way, or where we might have to compromise on one of our criteria. We simply don't make that decision, because once you start compromising once, you have to compromise over and over again. So with that, I hope this helps illustrate our investment process and how we think about some of our investment decisions. And I really wanted to use this example of Google because it is a controversial example. And some of you might say that we have missed Google because it has been such a great investment opportunity, despite not meeting all of the investment criteria that we have set out. So with that, I thank you for your time. I thank you for listening. and I look forward to your questions, comments, and discussing other investments that we have made or other potential investments and how we would evaluate them in our investment process. Thank you, and I look forward to hearing from you.